Great, Jamie. Thank you very much. And thank you to Paul and all the Saltmarsh team. I greatly appreciate the opportunity to be with you today and enjoyed Lee's comments as well at the beginning. And, the concept of being a trusted advisor is very much resonating with me. We have the same attitude at Janney and have for many years at FIG. And it's something that you earn every day and you can't rest on your laurels. And we all have to find new ways to execute on being a trusted advisor. And as you all know, it has been a particular challenge in 2020 with COVID, the new recession, just the curveballs we've all had. But we're going to try to have some hopefully very productive conversation this afternoon for the next 45 or so minutes. Take some questions from you and through Paul towards the end, and look forward to any feedback you have offline as well. You're welcome to send any questions directly into Paul and the team at Saltmarsh, as well as anything we can follow up with offline. We are happy to do that. So I'm going to drive here and just change our slides as we go along and make some points and emphasis. And I'll also delve a little bit beyond the slide presentation as well. So if you have the slides, that's great. If you get them on the back end, that's fine. And we'll go a little bit extemporaneous as well. So our theme today is asking the question, uninvestable. And that's a theme that we have heard from investors since March. And it is always a challenge sometimes dealing with, I call them the wise guys, institutional investors who have a lot of money and they're very trigger happy. A lot of times they have common sense, but sometimes they don't. And so you're constantly kind of working to try to explain the industry to them, to try to confirm their bullishness, to kind of deny their negativity, to try to maybe just explain how the sausage is made within banking. As many of you may know, our research kind of focuses on the banks from as large as the Truist, the BB&T SunTrust, all the way down to small private community banks. And what we really kind of like is having a different perspective than a lot of other people to maybe do a little bit of the digging that some other firms don't, and perhaps try to give a perspective that looks at many different aisles of the business to try to give the best advice to both investors and also to banks and their boards as well. So the whole concept of being uninvestable has been a challenge for me, and I'll explain why here as we go forward. So moving along, uninvestable is not anything super complicated. It's that you cannot invest. And the idea when the pandemic really became a thing in early March was that uninvestable was the phrase we heard. We can't touch bank stocks, whether they're large or small, big or big public or small private. We can't touch them because we can't invest in what we don't understand with credit quality, because the pandemic was clearly a black swan event. It was something no one really ever conceived. Maybe it was in a couple movies, but no one really ever took that threat seriously. And we found ourselves in mid-March with a pandemic that none of us really knew how to respond. The economy was shutting down. We had markets that were getting locked. It was not a fun month of March. And ironically, we ended the month of March even worse. And a lot of prices were temporarily locked. The Federal Reserve became increasingly involved, as you all remember, and so it just created a tough time frame. And my mentality has been and was and still is that there are solutions and there are ways to explain the problems, even if we can't see ourselves through the proverbial dark cave. There are ways around this challenge, and we just have to continue to fight and continue to address new challenges and really provide new answers and solutions to get through. And that's been my mentality. And so far, I think it's increasingly getting clearer where we are. And that's, I think, part of today's discussion is that I would wholeheartedly disagree with the concept of banks being uninvestable, because I think they actually are investable. I think there is real value and there's real opportunity. And we're seeing all kinds of signs of behavior as we go along. And, the great part of being invited to be with you today is it kind of forced me to get some ideas that I've had in my head on paper to try to tie together some work we've done already in our company and industry coverage the last 3 or 4 months and try to tie it into this presentation. But there's so much more we can talk about. So you'll probably hear some examples of things we haven't fully fleshed out, but that really are passions of mine that will continue to kind of drive some of our analysis in the months ahead. So the concept of being uninvestable is the idea that you can't own bank stocks because COVID-19 and really just this current recession is an unprecedented event there's insufficient data to analyze. And this ties back to credit primarily, because I think credit is the bane of most investors' worries. It's the bane of any bank director's worries, any banker's worries, any bank employee's worries. If you have good credit, you can sleep at night. When credit is somewhat suspect, or better said, uncertain, which it is today, it just creates a very challenging, untenable environment. However, I do think that it's solvable. The attitude, just to flush this out, is that the pandemic really means that banks can't estimate their loan losses, so therefore, how can I own stocks? Interest rates are going to be low for a long, long time. The Fed's back at a zero interest rate policy, or commonly known as ZIRP. And that there are more dividend cuts, and that if more dividend cuts happen, it's bad news for the banks. And also there's higher taxes, possibly a change of the White House, and M&A is on hold. Now, as we'll talk about, these points on this slide are really perception issues. It is correct at a moment in time that all of these things were true. And so if you go back to mid to late March, when the capital markets were really in a free fall and every day seemed to be worse than the next. And if you recall, just to remind you, the CARES Act was passed and signed into law on Friday, the 27th of March. And then a couple days later was the end of the month. So stocks were still kind of weak and markets were still challenged. There were banks that certainly had temporary issues on their mark to market for March 31st. That is better today, but unfortunately at the time it was an issue. Well, all these things were true to some extent, that at that moment the banks didn't have great data. They couldn't estimate their losses. The Fed obviously had cut rates to zero and dividend cuts were coming. However, we all felt that the fundamentals of the business were such, that dividend cuts were going to be modest. They were not going to be everywhere, and that banks were going to continue to work very hard to understand credit risk, assess it, start the reserve, and for that, and continue to march forward. And in my mind, march forward is the bank is open, they're doing business, they're making money, they're covering overhead and moving on down the road. And my perspective, being an analyst since the early 90s and having lived through, I think this is now my fourth financial crisis, particularly going backwards in time when you had just flare-ups in the industry, and of course the great financial crisis and recession of 2008, 9, and 10 was particularly harsh. But we don't have banks failing today, and I don't think we will. And I'll make that echo a couple different times today because I feel like we're in a much better position. But the point is, investors are worried, and therefore the concept of being uninvestable has been a challenge. I do think we can refute that. So my point here is that our experience is that cooler heads prevail. No different than any other conflict that we all have collectively been in our professional and personal lives. You definitely have a way to kind of address the situation. I tell my kids, I've got several teenagers now and some in college, that every problem has a solution, and I really believe that. So this is no different. I think banks are investable. I think that we are in a new credit cycle. COVID just happened to be the trigger. It may have been excess home building or excess lot inventories back in 2007 and 8 that triggered the last recession. This time it was a pandemic that nobody thought of and people didn't take seriously, and it just is what it is. But now that it's here, the key is, what is the behavior change? What are the opportunities that come about? And I really think that community banks are in a really good position here. And, I'll go off topic for 1 second, which is, just remember what we all have lived through since April with the PPP. As crazy as the PPP has been, with the changing rules and the constant back and forth with Treasury and SBA, it's been a net positive for the banking industry. The banks have been the conduit to put money out from the government for relief. And frankly, the community banks have done a way better job than the large banks have. The large banks may have more sheer dollars just because they're larger, but the actual impact is way better for the community banks. And all of you on the line know from personal direct experience, you have lived it, that there have been many stories of the large banks not executing and therefore making people unhappy. And as we are going to talk about, the changes with technology make it easier for customers to switch. And it is easier, in my opinion, for a large bank customer, particularly on the commercial side, to switch gears and move to a mid-size or community bank. I think it's happening. It's happening in droves. I think the data that myself and other analysts do are only going to catch up later to capture what is really happening today, which is business is moving, and it's moving towards community banks. I see it in the deposit data that I've studied the last couple quarters, and I think it's going to be even clearer as we head into year-end, early 2021, when you really have a handle on how much change occurred in 2021. My point, as I echo here, is that banks are better positioned today with more capital and less concentration. We have PPNR that is solid. PPNR is the Fed's acronym for pre-tax, pre-provision net revenue. It's simply a pre-tax with your provision expense added back. And we have tangible book value that's growing. There are many banks who are growing tangible book. I did a study for myself this morning just to remind myself some data, and there's a lot of banks who have grown tangible book, at 7 or 8% in terms of compound annual 7 to 8% the last 10 quarters. So if you think about that for a second, the last 10 quarters from the end of 17 through the middle of 2020, you've had a median of 7% growth, and really in a lot of cases 8% or better compound annual growth of tangible book per share. And by the way, that statistic excludes security gains. So the fact that security gains have gone up because of lower interest rates, that's nice, but I can take that out and still show you that tangible book value has grown. And that's true whether you're a private, public, large, small, book value is largely growing, and it has grown most of the time for the first 6 months of 2020. That's something that makes me happy, thinking that the banks are on good footing. And while they do have their challenges and profits are down because of the COVID and the reserve building, but the banks have the ability to continue to churn through this environment and get to the other side. And even though we may not know when the other side is, it may be 3 quarters, 4 quarters, maybe longer, I still think banks have the ability to weather this storm. They're in a much better position than they are. This is not the first time we've seen low interest rates. The Fed was at 0 interest rates in December of 2008, and they stayed that way for 7 years, maybe 8 years. So it's really not that unusual to go back to where we are today. And I still argue that dividends are intact for the industry. We can talk about dividends further. I think the Fed has a handful of examples where they've asked to cut. Wells Fargo, Capital One, a handful of others, but really 80, even really 90% of the industry has kept dividends intact. And, knock on wood, I feel that as we get to September, and particularly end of this month and into September, October, that the Fed is going to allow dividends for most of the industry. And if the pandemic and the economy get worse in fourth quarter, then we'll have to adjust, but I just don't see that happening just yet. And I'll give you some examples of why as we go along. So just a couple of things, I'll try to move quickly through some of these slides, but just to give you a perspective, it's night and day between the stock market and banks. This is as of Friday, and what you find, and it's about the same today, that $1,000 invested in banks in the S&P 500 at the end of December, or really mid-December before the holidays last year, is worth almost $1,100 today in the stock market. Thank you to Amazon. Thank you to all kinds of other, well-known tech companies, Apple, et cetera, who have done quite well. And then the banks are actually down over 30%, and you're worth about, $680, $670, depending on which bank index you want to use. So the banks are down over 30%. The stock market, judged by the S&P 500, the equity basket, is up almost over 9 or almost 10 when you add dividends. It's a stark difference. Now, the negativity in banking has to do with the last credit cycle and the fact that people lost money, banks failed, the industry struggled, as all of us lived through in 2008, 9, 10, 11, however far you want to take the credit cycle. Then it's a different animal today, and the market unfortunately has penalized banks sooner. But I feel like this is a temporary change, and it's not permanent, and that the bank industry is going to actually repair value over time. It'll take us a little while to get back to par, but I do think we can get back to par. I think the industry is a much better footing. Reminder on GDP over the long run. This long-term graph, actually, I just decided to do it since I was born in the late 60s. And what's interesting to me, to go back 50 plus years, is that it's been a relatively steady growth of the GDP in general. We obviously know there's been recessions in the mid 80s, the late 80s. A small recession before 9/11 happened with the dot-com era, and then of course the recession that we saw 11, 12 years ago in 2008 and 9. When you look at the sheer drop of real GDP this year, it was obviously a modest change in Q1 because the pandemic had really kind of took hold in mid-March, and then just to completely fall out of bed with the economy shutting down in Q2, as you remember, and now we've got a snapback that's over 25% pace this quarter. And what's interesting to me is when you do the math on that, you end up with a net drop of 4.5%. 4.5% is not great, but it's also not 90. And it's also not the 30% decline that banks have had. So just think about 4.5% contraction in the economy as we sit here in September. And that's applying the real GDP growth forecast that the Atlanta Fed does, which I actually think is pretty good. We pay attention to it, so do a lot of other investors. And I think it's a good way of thinking about where exactly are we here on September 1st, 2020. We're down 4.5% for the economy. And so clearly that's hotels and restaurants and travel related industry, but it also incorporates the positives of construction that's gone up, home activity that's gone up, mortgage refinancing, all the activity that's happening at Home Depot and Lowe's, and pick other retailers that have done very well through this pandemic, Walmart, Target, etc. That says a lot about that the economy is not down 10, 20%. It's actually only down 4.5%. So just keep that in perspective. I do think that's important. Here's inflation. I have seen very little inflation in my career. It is clearly a position now where there's concerns that inflation is going to come back. We'll see. There's also, fears of all kinds of bad things happening that hasn't happened yet. But I do think that inflation is something to watch. I'll share with you my theory on it in just a minute. So here's two periods where we had minor flare-ups of inflation, 2004 to 6 and then 2010 to 12. It really wasn't that big of a deal. It just simply went from, near 0 or 1% back to 3. And that might be what we're going to live through the next couple of years. We'll see. I think that it could be interesting to interest rates if the inflation does indeed happen. My colleague here at Janney, who does a lot of technical analysis and is really good, pointed out some interesting data last week that I thought was germane for our discussion today. And that is that back in the 1940s, the Fed had a zero interest rate policy. They had that for many years. And it eventually did lead to changes in interest rates in subsequent decades. So again, not to imply that we're going to be here for 10 years. Maybe we will, maybe we won't. I think the thing to remember is that, the show does go on. The sun does rise and set every day. And, banks survive the 40s and they'll survive the 2020s as well. So we probably are repeating ourselves here, but I also think that that goes both ways, and repeating itself also comes back to inflation and interest rates rising eventually. So this is a long-term chart of interest rates. I believe these rates here on the long yield is going to be the 10 and 30-year bonds. So if you look at the 1940s, you can see how interest rates were kind of in a very tight band for a while, and then they eventually worked their way higher. And again, the war had a lot to do with this as well. So I can't profess to be the perfect economics professor, but I do think comparing where stocks and long yields were in the 40s to what eventually happened when the economy did go back in a growth mode does bear interest. And I think also is worth reminding the fact that these things do come and go, and that was a point I wanted to make with you. I happen to think that the way we behave has a lot to do with how good or how bad this environment's going to be. So an article we wrote back in March, because we think it was real important when the Fed and FDIC made their rulings. If you remember, it was a Sunday evening that this news hit. We did the article shortly thereafter. We felt it was important to discuss the unprecedented regulatory solutions that had come out. And granted, at the time, as you can see in this headline, we were complaining a little bit that more was needed, more clarity was needed. And of course, it is and was, and we got some more because the CARES Act had not been conceived yet. It was still in formation. CARES Act happened about 8 days later on the 27th of March. But my point was going to be that, the banks have at least some guidance, better than none. And what's happened in the excuse me, in the months afterwards, is that there is a there is some clarity about how the regulators want to make it easier for banks and not tougher for banks. This communique in mid-March told us that the regulators are going to be friendly, they're not going to be adversarial. The regulators are going to be helpful, they're not going to be hurtful. Now, we walk that tightrope every day, and if banks are not careful, they can still make mistakes and still get themselves in a regulatory snafu. So I don't want to kid myself and say everything's wonderful, because that's not true. I do think that we have better solutions, a little bit of a better time, more understanding from the regulators, and I think that's very helpful. And I think the whole concept of forbearance has been very useful. We still have to work the rest of it through, but I do think that it is a better time than what seemed to be a very adversarial relationship between banks and regulators back in 2008 and 2009, which was not productive. It led to a lot of bank failures. It led to unnecessary dislocations, and that does not appear to be happening as we stay here today. Okay, one break in the action as we have two code words that we're sharing today. So let me just pause that one of our code words for anyone doing CPE credit, the first code word is uninvestable, which is the title of the first 2-3 slides. So the word uninvestable is your first code word. And there's a second code word that I'll get to, I'll remind you of here in a few minutes so I don't forget. Okay, so one of our, I think, points about the whole forbearance and the environment that we're finding ourselves in is that banks have to understand the TDR rules, and they have to understand what defines a TDR. And obviously, the whole concept of TDR has been delayed for 6 months because of forbearance. That doesn't mean banks have to forget what the rules are and how to navigate. So these talking points were kind of created at the same time the CARES Act was, and I kept them here because I still feel that they apply. Banks have to find a way to work with customers. Banks have to find a way to work within the rules. And to some extent, banks have to understand what triggers a TDR and try to do the opposite to kind of work with their customers. Now, the forbearance that has happened the last 6 months has been very useful, and I think has sort of helped to kind of soften the blow. I think it's also bought a lot of borrowers time, a lot of banks time, to really figure out where is their chlorine needed in the water and where there are customers who simply just had a dislocation and can get back on their feet. I think accommodating borrowers, I think deferring principal, I think creating structures like an A/B note structure to make it easier for your customer to survive this is absolutely in their best interest. I still encourage banks to do that. I think that it is helpful to keep a really good file so that you have on file, even for the next couple of years, that there was a moratorium on foreclosures, that there were all these other information points given both locally and nationally from your regulators. I think that keeping good records really does matter. And a lot of banks that I spoke with early in March, when this was all starting to fall apart, all said, if you make it like you would have done a hurricane or you would have done a tornado, document, and do your best to avoid fraud, you generally can find solutions that work for customers and obviously also appease your regulators that you played by the rules, kept good notes, and did the right thing for your borrower. I think a lot of banks understand that really well. That's a little bit old news, but it's also worth talking about the fact that I do think that we have been able to get our hands around credit. And I do think, even though credit quality will look worse at the end of September and the end of December, I still think it is a fire that we can put out as an industry. And I feel like investors are more spooked and nervous than they need to be. And I feel like as we get through the next couple of months, that it's going to be an increasing acceptance that the banks are in better shape. Therefore, we should treat the stocks a lot better than we have. Obviously, forbearance and foreclosure is out there. I was just going to make a quick mention about CECL. Obviously, the changes to the accounting rules for the mid-size and bigger banks came at the absolute wrong time. It's always how these things happen. Tends to be Murphy's Law. Our point a couple of months ago, it still is accurate today. I think that the industry, with the noise of credit provision, we have to go back to looking at companies on a pre-tax, pre-provision ROA. And I think we also have to, to some extent, remember that we're going to have noise on provision, whether it's related to an accounting change like CECL, or because it's related to a economic recession like we have now. You still want to go back to the base business of how does the bank make money? How are we making money on spread, on fees, and then on expenses, and how do those shake out? And I like looking at it on a ROA basis relative to return on average assets. I still think that has a lot of applicability whether we had a pandemic or not. And I think that because investors see a lot of noise on the accounting, they're increasingly thinking about the pre-tax, pre-provision revenue, that PPNR relative to assets. And increasingly, that's a way that they are judging. I do want to mention the sort of concern and threat about the White House. No matter where you fit on the political spectrum, I think it's fair to say that we have to understand the good, bad, and different about change in the White House. I think that if the polls are correct and Biden ends up taking over, that there are going to be some natural things that automatically happen. There are agency heads that will change. That happens with every presidency shift. There should be limited change at the Fed. So the Fed governors are 14 years in tenure, should not have any changes unless there's a personal change. So for example, Randy Quarles, who is one of the supervisory governors for the Fed, Randy's got all kinds of personal interests. He comes from a well-to-do family. His wife is one of the original founding families of Salt Lake City in Utah. He probably will go back to private life, but that has nothing to do with the White House. That has everything to do with Randy's personal situation and really a lot of different skills that he brings to the table and the family office that he's part of. And I think that'll all probably shake out whether Trump stays in the White House or whether Biden goes to the White House. I don't think it really matters. You're going to see some turnover. It's believed that Jay Powell will stay in his job for a while. He certainly seems to have taken less heat than he was pre-pandemic. But some of those changes may be for personal reasons, not because they have to change. The only people that really have to change tend to be a appointed head like the CFPB, HFFA or HFA, et cetera. You could see the FDIC chair change. OCC already has someone who left, and that job has to get filled. So you may see shift anyways on that. The other points that we would make about banking under Biden, if it happens, is that a lot of the people who run these regulatory agencies are really the lifelong bureaucrats. I don't mean that negatively. I just think that's their role. And I think those lifetime operators, regulatory operators, they're not going anywhere. So the men and women who truly run the day-to-day operations of the OCC, the Fed, FDIC, et cetera, even at the state local level, I think those folks continue to run the business. And I don't think the regulatory change is going to be as swift as people worry about. So we're trying to educate the world with this thought process. The link here on this page goes to our industry piece we did in July. Take a look at it. I think you'll find it interesting. We make the point that we think that there probably is going to be a change in tax rates. If Biden gets in, I think it'll be a small 4 or 5 point. I think that's easy to sell. If you have a 5-point change in taxes, that's going to lead to about a 7% drop in earnings per share. It's not that big of a deal. It's 8-9 basis points on return on assets. I would rather not have that because I would rather maximize profits. I'm sure all of you feel the same, but it's not going to be any type of real gut punch to the industry. It's just one more headwind, and we'll deal with it as a banking industry and move on. So if taxes go up, we'll handle it. I don't think tax rates are going to change more than 5 points. I think it's too much to sell. We really have to see, does the House and Senate both change, or does the Senate change parties and we have an all Democratic Congress and legislature? If that happens, then maybe more changes could occur. But even then, I think there's a lot to get a tax bill through that's going to be, back to 35%. I just don't think it's going to change that much that quickly. So just food for thought. I do think CRA is going to probably be one of the leading themes coming out. I would argue that there is a time and place now to modernize and digitize CRA. Everybody's got a cell phone. There's a way to mitigate the issues within CRA with digital activity and really tracking where people are. And I think that's going to happen. And I think it will happen even if there's no change in the White House. I just think that's something that's going to evolve. And that could actually be very healthy for the industry if it occurs. So that would be some of my predictions on the political side, because I do think it's germane at this juncture. The other code word in our talk today for CPE credit is the word real. So we talked about the real GDP back to inflation. The word real is the second word for CPE credit. So if you want to jot down the word real, then you will be covered on that. So a couple of missing ingredients in banks. We've made the argument that the credit issues are solvable. Even if the pandemic doesn't have a conclusion, we think you can solve these issues. I think criticized assets is the best and most important thing to look at. We have spent a lot of time the last 3 weeks taking the reported 10Q filings for large, mid, and small community banks that are public and dissecting their disclosures, which are far greater today than existed 12 years ago, and looking at the criticized assets. A lot of you know that the criticized asset and the classified assets have always been in call reports. They've been redacted. So folks like me as a public user of the financials can't access that. Well, the SEC created reform, and since 2013, we really have seen much better information given by banks so that you can get a handle on what is a substandard loan, what is a special mention loan, and you could therefore have a good understanding of where we are from a credit perspective. That data is very helpful today. And even though we don't have a full picture of criticized assets at June 30th, I do think we're going to have an improved look at the industry at the end of September and again at year end. And while I do expect criticized assets to rise, I also think that the level of criticized assets is much smaller and digestible than it would have been 10, 11 years ago. Low interest rates are a headwind. I mentioned that. The real changes that need to occur in banking is structure of costs and overhead. That's going to change. We all have seen, and I'm sure you have lived through it as bankers day to day, the acceleration of digital banking, the adoption, the use of non-branch opportunities. Certainly, the drive-through is more popular for those of you who have them. All of that's going to lead to decisions in the years ahead about cutting branches and changing the way we do business. I do think that staffing is going to change. I think there will be some reductions in overhead from a staff perspective, but I really think it's going to be more about the process that changes and that takes costs out of the business. And I think M&A is also going to support this process as well. An advertisement on criticized assets is some analysis we did earlier in August that just reminds you from the publicly available information since the SEC allowed the classified and criticized data to be issued for public companies, that it was routine to have criticized asset ratios over 55%. And in fact, I think if we knew how high criticized assets were in 2009 and 10, we all would be laughing about how worse it was then compared to it is today. I would argue that classified assets are 15, 20% of capital and reserves today. It's going to go to 40 to 50, maybe 35 to 45, but it's not going to be a whole lot worse than 50% for the majority of banks. We are building capital, we are building reserves. We also have less leverage because most banks have at least 100 to 150 basis points more capital, which means they have less assets against capital than they did 12 years ago. It's just a different industry with less concentration, more capital, less leverage, less risk. And therefore, it's going to come out in this pandemic that the losses, while there are some, it is not going to be as ugly as what we survived in 2008, 9, and 10. I emphatically believe that, and I think it's going to play out. And I think the criticized asset ratio is the number one thing I'm watching today and will continue to watch in the next really 4 or 5 quarters. But I think particularly the next 6 months will really tell us a lot about where the industry is. And I do think that while the criticized assets rise, I think it is going to be a more moderate increase. And it's a problem that the industry can digest. It will digest, and we will move forward and still see this industry survive. And I think, again, at the community bank level, it will thrive. So a couple of points we did, and I probably won't hit on everything, but I want to hit on a couple thoughts that if I could leave you with in our time left. I really think that costs are what's going to change in this industry in the next couple of years. And again, I mentioned that interest rates were low from 2008 to all the way to almost the end of 2015. We're right back where we were on the Fed at zero Fed funds. It is what it is. Deposit costs have come down. Banks are now doing better at getting their deposit and their CD rates down. It's going to continue to reset the next 2 quarters, but it's very healthy. I love the fact that deposit flows are strong. We see more banks with rising DDA ratios. We know there's a big inflow of deposits, and that doesn't seem to have gone away. Even if the PPP comes and goes the next 6 months, I still feel that deposits are here to stay in the industry, and that growth in deposits is quite good for the industry. And I think that is a lasting part of this pandemic, just like it was for the recession 12 years ago. Deposits grew for several years after 2007, and the industry did not look back. And I think that that will be exactly what happens here. So what changes is less about spread and net interest income and more about the cost of doing business. Getting costs down, getting branches to be reduced, doing more with less people, perhaps shifting people away to other processes and doing more digitally. Bringing new customers on digitally is a lot cheaper than bringing them through your existing structure. All of that is just at the infant stage. And just because Bank of America has been bragging about it the last 3 years, and JP Morgan too, doesn't mean they figured it out. They've got a lot of legacy systems that they've not figured out yet. And I would still argue that B of A is B of A. B of A is clunky. B of A can get in their own way. We saw it with PPP. We'll see it again with other changes. So they like to brag, but they're not always good at executing. So just take the big banks with a grain of salt. I think the relationships lie with community banks, and there's a lot of those relationships that are moving because they can, and community banks end up being, I think, the beneficiaries of that. The key is how you manage, how you attract business, and I think you have to, of course, try to pick your customers where you really can make a difference and not try to bank everybody. And I think that's really the key to this. The other point that comes out when I think about and do these studies is that the banks who grow leverage their costs. The banks who grow tend to do more business with the same customers because those customers have multiple relationships. Think about a property owner who's got 20 multifamily assets. If you do 1 or 2 of those, but you're able to take that relationship to 5 or 6 of those assets, you've increased your wallet. And the cost of you doing that business was very small to get those additional 2 or 3 properties that you lend on. There's all kinds of examples like that in banking. That's where I think the business is going to go. We are going to see consolidation. One of the requests that Salt Marsh asked me to do today was talk about M&A. And I decided to talk about M&A and do less on the slides because I think the better picture for M&A is where are we going? The industry's had consolidation for my whole career. When I got in the business in the early 90s, we had, I think, 16,000 banks. We now have got, 52 or 5,300 banks, and we'll probably have, 3,000 or 4,000 banks in a couple of years. So we are going to continue to narrow the banks. It'll be smaller community banks that change in terms of the sheer numbers, but you will see some big banks like the SunTrust and BB&T marriage and others that'll come out. PNC's on the march to buy somebody with their BlackRock funds. All of that's going to lead into change in the industry. So my idea is that the banks who ultimately stay in the game are the leaders. The banks who want to leave, they'll take this opportunity to leave, and that's okay. Their boards might be tired. Their boards may have a good opportunity to sell, take a good currency. That's going to happen, and I think that is a natural part of the evolution of the banking system. And I think the strong survive, but also the leaders survive, and it's the leaders that I think are going to be around to grow. And there's a lot of really good community banks. They might be less than $1 billion, they might be more than $3 billion, but they tend to be community banks, and they tend to really be growers and thoughtful, and they're bringing on some really good people that are changing gears and leaving Wells Fargo, or they're leaving SunTrust or BB&T, and they're coming to these community banks, and they're making a real difference. And because the cost of technology is cheaper, you can do a lot with the talent that those bankers, men and women, bring who've got good books of business. And that's going to ultimately drive costs going forward. So again, this point in this slide is really that the growers get the biggest benefit from costs. The low growth companies do not. But again, the ones who are going to survive and thrive in the next 1 year, 2, 3, 4 years are going to be growing companies who take advantage of this environment. Some background here that I won't spend too much time on, but we did some studies back in February before COVID became a thing, and it was just really kind of drilling down on the fact that there's been this shift away from large banks. Despite what the newspapers will tell you, there's been a whole emergence of mid-sized banks. Mid-sized banks that are above $1 billion, but less than 50. That market share has stepped up. Banks who are between 10 and 20 billion are really one of the best growth areas of the business right now. And while that may not apply to some of you on the phone, I still think that the same idea of how a bank that was 9 or 10 billion now became 14 or 16 billion, that same thing's going to happen if you are 800 million going to 3 billion. And there's an awful lot of growth of shareholder value, of sort of personal value that occurs when a bank goes from 800 million to 2 billion or 800 to 3 or whatever your step up is. There's a lot of value created. And it's particularly what I'm passionate about as a community bank investor and a community bank analyst, because we think some of those best days are ahead. Some of those community bank stocks that are alive today are trading at big discounts to book. And I think book is growing. We've seen book grow the last 6 months, and we think that the business is better than the market suggests. And again, the data pre-pandemic all suggested that there was a shift of market share and it was coming away from the biggest banks. So food for thought. There's some more background here on these slides. You're welcome to take a look at it. I'm happy to talk with you offline. I still think that deposits rule our industry. Deposits are the key source of growth. I think that there is a lot of inertia in that it's hard for customers to move their checking account. It is easier to move lending relationships, and that's where the PPP discussion comes in. But I think that with technology, it's actually going to be easier to move deposits too. We're not there yet, but we're going there. But honestly, I think that impacts community banks in a better way. I think it's more positive for community banks. If they play their cards right and they stick with their relationships, the deposits are going to follow. It's really about training yourselves and your team to move those deposits, to ask for the business, to make sure you're not paying 125 for a CD when the market rate's 80 basis points. Those are where the value can be harvested because you have a relationship. I've said this many times and still feel that way, even with the pandemic, that there's 3 legs of any relationship. It is the accountant, the attorney, and the banker. The banker, he or she has an absolute seat at the table. They are just as important as the accountant and the attorney, and the banker sometimes doesn't realize how important they are. That's the source of credit. That's the key. It's that relationship with the banker that those small businesses desire, and they desire it even more now in the middle of a pandemic. And a lot of the people who are unhappy about the way PPP went down with the biggest banks, they're fed up and they are changing in droves. And I'm very confident that a lot of you on this call know and have experienced that. And I think that is not just a temporary thing. It's going to happen for many, many quarters, and technology only makes it easier. I've got some background here that I won't bore you all with, but just some interesting reading materials on some work we did, again, pre-pandemic. And so with COVID and PPP, the numbers get a little bit funky if you try to look at just where we are for June. So I think looking at where we were year end is interesting. The point I was making then and still make today is that when you think about fintech, a lot of it has to do with, who is going to win the deposits. The deposits for all of these sort of nouveau banks or neo banks around the world, they really haven't moved much deposits. They are opening relationships and they are doing things and they are creating some new buzz, but they really haven't moved the deposits. The US compliance system still drives, and it's still hard to get a bank charter. It's not easy. There are a couple new entrants. They're coming. Vero Bank is one. There's a few others out there. Radius Bank is selling itself to Lending Club, and that should be approved next year. But those are small examples. The major movement in deposits has all been with existing regulated banks. Having a regulatory bank charter still has value, even if the stock market is ignoring it today, which it currently is. So when you think of fintech, I think of it more as taking costs out, creating opportunities for banks to be better, to offer better services, to strip out costs, to do more with less. I think that ultimately is where fintech is going. I think it's an important thing to track. I do take it seriously, but I think that you have to take it with a grain of salt, because again, the deposits really haven't left the system. If anything, the deposits are growing and there's more of them. So there's some background here, and we talk about acquisition costs and cost to acquire. I do think that's a key thing, and I think that that's something that we will watch about. So there's some background here and just some other information about kind of branch light banks that are out there that you may read about, and you can see their cost of doing business as a year end, and it's something that we're tracking. So those kind of the wrap up part. I wanted to leave Paul some time to ask questions and chat about things that are on your mind. So let's go right into that, if that's okay.
Great, Chris. Thank you so much. I know everyone is experiencing the very topic that you brought up, and that was deposits. We've had so much media attention about PPP loans, but the real story is for every dollar in PPP loans, that brought along a couple of dollars, several dollars of deposits. And so I think all of our institutions are dealing with a balance sheet that doesn't look anything like what we thought it would look like before we went into this year. One of the challenges that a lot of bankers are dealing with is, as you mentioned, with the low interest rates, it's great on the short end, but on the longer end, that is so problematic of what to do with those deposit funds. You mentioned that you weren't as concerned about the margin, and I agree with you on the cost and efficiency, but what are your comments about the fact that we've got not only low rates, but a low flat curve? And so the opportunity to put those deposits into something is pretty limited right now.
Correct. So I think a way to fight that is to really think about how much liquidity do you need to keep on balance sheet? How much liquidity can you kind of keep at your fingertips, right? So a lot of banks for years have had great relationships with their home loan bank, with other providers, perhaps having a bank line of credit with another outside larger regional bank, like U.S. Bank has been in that business still since SunTrust got out of it a decade ago. I think having that liquidity is really key, but I also think you have to manage how much of that do you really have. Is there too much liquidity that really hurts your returns? Or does that excess liquidity kind of, burn a hole in your pocket where you're buying assets that you may not understand? If you go back a couple of years ago, banks were buying assets from consumer finance companies just because they wanted to have diversity, and they all of a sudden realized they were going to start losing real money because those consumer finance loans had a lot higher charge-off pace than what the bank was used to doing. That was kind of the lending club or other type of fintech partnerships that ultimately created assets, but they created more losses too. So I think you want to think about what you want to buy. Now, there are, I think, some well-developed networks where you can buy FHA or Freddie Mac type of multifamily deals and get it to where you have some type of yield. We've seen banks invest in subordinated debt with a pool of institutions that are issuing. Those could be good ways of getting a 5% return into your portfolio. It doesn't have to take a lot of risk, or certainly you can manage that in terms of having a small bite-size set of investments. We think that's something to think about. But I also think to some extent that maybe managing your liquidity to where you've got access to liquidity, but you're not necessarily saddling your balance sheet. So it's almost like an efficiency idea of, can we manage the left side of the balance sheet efficiently, or perhaps more efficiently than we had? I think there are opportunities there to do that and to manage cash. I do think that sort of headwind, to your point, Paul, is going to be with us for a while. But that's one way I would try to combat that.
I know a lot of bankers are kind of struggling with such a low flat yield curve. Should I just park the money, and my balance sheet looks real bloated right now? How will analysts and investors look at me if I do that periodically? And I'm, a lot of times not real happy about tying up the yields on securities or, as you mentioned, other assets. So I think the default is looking at maybe investment securities with a relatively modest duration and maybe putting that money out for a while. And I know that some bankers are also looking at that extra cash level from the PPP deposits and maybe looking at paying down some of the FHLB advances or other advances and kind of keeping some powder dry, as you mentioned, another funding source. So the kind of analysts view our community banks right now, we are a bit chubby right now. We're certainly got more of a balance sheet. As you said, a lot of the growth isn't really planned growth. It was kind of PPP and the related deposits growth. Are analysts expecting us to shrink back down a little bit as the PPP volume goes out, or do you think those deposits will stay beyond the maturity or forgiveness of the PPP loans?
So good question. I think the deposits are going to stay. I think that the expectation is for banks to be careful. I think that banks who are going to grow loans in the environment just have to be careful to just really pick their spots. There are banks who have brought over new lenders, and those lenders, the men and women, have books of business. And I think if you have a comfort level in the type of loans that you're doing, I think that works. But I generally think that is replacing loans that have run off, and so the net growth is going to be relatively modest. And to me, it feels like it did in 2009 and 10. That loan growth is going to be limited. It's more about managing credit and making sure that you are dealing with the credit issues that you have, even if they're not catastrophic, but they're still enough. Every bank is going to have some lingering, non-performing assets after the forbearance ends. So it's just a function of managing those and trying to work with those borrowers, restructure loans where you have to. I sense that, some banks will have a contraction from interest income in some lending because those have to be restructured from a non-accrual standpoint, but helping that customer see it through is really key. And I think the deposits are going to be with the system for a while. I just don't think rates are going to change enough to really push deposits away from the system. And, I implied it earlier, but I think the value of a deposit charter, the value of deposit insurance is still really, really high, and which ultimately means the value proposition for a bank still exists, which I think is a key thing in, this whole discussion.
And that is always encouraging when we look at banking versus some of the fintechs, is that banking has an infrastructure and a customer acceptance of in a flight to safety situation that we depend on. We did get a question about whether you thought de novos were uninvestable. I'll just give you your last, you got one more minute. How about, but I suspect, de novos are going to be few and far between, and the successful ones will be an assembled management team and board that has something in their community to really offer, but it's going to be tough, I think, for de novos.
I agree. I think that some de novos will happen. We have seen a few approved. I think a few more will be approved. I think it's good for business with the FDIC to not have a zero, allowance. I think you have to have some new bank start. I think it's healthy for the business. The key for de novos is just returns. I get periodic requests about de novos and would I or should I invest in this? And my attitude is it depends on your return horizon. If you're okay with a 4-year investment, expecting that the bank will most likely lose money in years 1 and 2, sort of break even at some point in year 3, and make a little bit of money in the 4th year, that's a low return relative to other investment alternatives. But if you want to have that, it's certainly an acceptable deal, because as you get to years 5 and 6, and that bank really starts to catch hold, you're glad that you got in on the ground floor. I think, like a lot of things, I think it's all about the diversification of one's portfolio. I think there is room for de novo banks in one's portfolio. You just have to have a longer perspective with them and not expect that they're going to make these big returns. I think that some of the companies who were here for a couple of years and hit it big back in the mid 2000s, those were just unusual situations that aren't being repeated. I do think there are companies with good concepts that can survive and create a franchise. It just takes them, a good 4 or 5 years to really catch hold. But in a major market, it certainly could be a thought because it's a cheaper entry point. It just has to have the right level of patience and perspective with the investment.
Sounds great. Still a great business to be in. Chris, I want to thank you so much. You and Janney, the Janney team, offer such great thought leadership to our industry. I know a lot of us look forward to reading your pieces every morning, and I just wanted to thank you for taking some time and talking with us. These are interesting times, and you always have interesting comments. So thank you very much.